Silver is trading at $82.39 per ounce as of midday Thursday, March 5, 2026. Despite escalating conflict in the Middle East and continued disruption linked to Operation Epic Fury in the Strait of Hormuz, the metal remains in the low $80 range. Oil tankers have been struck, shipping routes are under strain, and geopolitical tensions are elevated, yet silver prices have not shown a sharp upward move. According to the report, the primary development influencing silver is not currently visible on precious metals charts. Instead, attention is directed toward the global energy market, specifically diesel and gasoline exports from Asia. The article states that the Chinese government has issued an emergency directive to its leading state-owned refiners, including Sinopec and PetroChina, ordering the immediate suspension of diesel and gasoline exports to international markets. The directive took effect Thursday morning, Beijing time. The report explains that China is retaining domestically refined fuel in preparation for a potential disruption of crude oil imports through the Strait of Hormuz. It further notes that Japan has announced similar fuel export restrictions. India is reportedly preparing comparable actions, and South Korea is holding emergency energy meetings. The article describes this as a shift by major Asian refining nations toward prioritizing domestic energy security. The report emphasizes that silver production is highly energy-intensive and closely tied to diesel availability and pricing. It argues that developments in the fuel market could have direct implications for the cost structure of mining operations. The article explains that silver does not enter the market without a complex and energy-intensive production process. Approximately 70% of global silver output is produced as a byproduct of mining other metals such as copper, lead, and zinc. These operations are typically large, open-pit mines located in countries including Peru, Mexico, Chile, and China. Mining companies extract millions of tons of ore to recover primary metals, with silver obtained as a secondary component. According to the report, these operations rely heavily on diesel-powered equipment. Large haul trucks, excavators, bulldozers, loaders, and drill rigs operate continuously using diesel engines. Once ore is removed from the pit, it must be transported to crushing facilities, requiring additional diesel-powered vehicles running around the clock. At processing facilities, industrial mills grind the ore into fine material to separate metals. These mills require substantial electrical power, which in many remote mining regions is generated by diesel or natural gas turbines due to limited grid access. After initial processing, concentrated metal is transported to smelting and refining facilities, sometimes across international borders. Cargo ships used for transport operate on bunker fuel, a heavy diesel-based product. The report underscores that each stage of mining, refining, and shipping depends on energy inputs. The article references the industry metric known as all-in sustaining cost, or AISC, which represents the total expense of producing 1 ounce of silver. This includes energy, labor, equipment maintenance, regulatory compliance, and other operational costs. For most of the past decade, when energy prices were relatively stable, AISC for silver miners ranged between $18 and $22 per ounce. The report notes that in early 2022, following disruptions associated with the Russia-Ukraine conflict, diesel prices in the United States rose from approximately $3 per gallon to more than $5.50 in some regions. In Europe, prices reached the equivalent of $7 to $8 per gallon. During that period, several major silver mining operations reported increases in AISC from around $20 per ounce to between $28 and $32 per ounce within a single quarter. The article outlines how further increases in diesel prices could affect silver mining economics. Energy expenses typically account for about 30 to 40% of a mining company's total operating costs. If diesel prices were to double from $4 per gallon to $8 per gallon, overall AISC could increase by roughly 30 to 40%. In that scenario, a miner operating at $22 per ounce could see costs rise to between $28 and $30 per ounce. The report further suggests that if diesel prices were to triple or quadruple, rising to $12 or even $16 per gallon, AISC could move into a range of $40 to $50 per ounce or higher. At a market price of $82 per ounce, this would narrow the margin between production cost and selling price once taxes, dividends, debt servicing, and capital expenditures are considered. According to the article, under sustained cost pressure, mining companies could respond by slowing production, suspending higher-cost operations, or delaying development projects. Reduced output would affect the volume of newly mined silver entering the global market. The report describes a potential timeline in which diesel price movements could become visible in futures markets within days. By mid to late April, when first quarter 2026 earnings reports are released, companies including First Majestic, Pan American Silver, Hecla, Fortuna Silver, and Mag Silver are expected to publish updated production figures and cost guidance. The article states that these updates may reflect increased energy-related expenses. In its concluding section, the report addresses the relationship between COMEX futures pricing and the physical silver market. It explains that physical silver products are already trading at premiums above the paper spot price, with 1-ounce rounds and 10-ounce bars selling at approximately $3 to $6 over spot. If supply tightens due to higher mining costs or reduced output, these premiums could widen further. For example, if COMEX futures remain at $82 per ounce while physical silver trades at $94 or $96 per ounce due to a $12 premium, traders could purchase futures contracts, take delivery, and resell into the retail market. The report states that sustained discrepancies between paper and physical pricing would likely prompt adjustments in futures markets. It also notes that industrial demand for silver, accounting for approximately 50 to 60% of annual consumption, includes applications in solar panels, electronics, electrical contacts, medical devices, and water purification systems. These uses rely on silver's electrical conductivity and antimicrobial properties. Investment demand for silver as a monetary asset is also referenced. The article states that when supply constraints coincide with ongoing demand, price adjustments occur to balance the market. The report provides historical examples of supply-driven price movements in other commodities, including oil during the 1973 embargo and the late 1970s Iranian crisis, copper during the early 2000s expansion in China, and uranium between early 2023 and early 2024. It concludes that fuel export restrictions by major Asian refiners, combined with geopolitical developments and energy market volatility, represent a supply-side factor influencing silver production costs and broader market dynamics in the months ahead.